Hey, everybody, and welcome back. So if you took the time, or if you didn't see it, we'll give you the link for that as well, too. We did do a session not too long ago about tax prep readiness, getting you and those around you ready for tax season. And why I do the air quotes is because we do not call it tax season around here, teaching tax flow. And maybe we'll talk through that a little bit why. But before we get into that too, Chris Picciurro here is as you can see him. Chris, let's get a little wave here for the fans. Oh,
hey everybody.
there we go. There we go. So Chris is joining us here, similar to the other session we did. Today's topic, though, we are going to look at tax savings for business owners earning over $150,000. So if you're making $150,000 and you're a business owner, you are in the best place you could possibly be right now. We're going to dive into some of these details. We got a list of some questions that's been sent to us. Chris, if you're okay with that too, I'm going to maybe kind of order these in the best appropriate place as you're kind of walking us through some of this stuff. And I do like this too, before we jump into it, business owners making over 150,000. So let me ask you a question here, Chris. Are we talking about businesses that have 150,000 in revenue, or are these the individuals that are 150K is what they got in their bank account?
Well, John, you must have listened to some of our other content, because what they have in their bank account does not mean that that's their profit. Remember, one of the laws of teaching tax flow and cash flow are completely different. This is for business owners that have $150,000 of net profit after expenses or more. In the teaching tax flow system, we use a process where we diagnose and prescribe. So in the teaching tax flow system, these are what we call red diagnosis. That means you are in a high marginal tax rate, especially if you're self-employed. You're paying that self-employment tax as well. So higher marginal tax rate people. We picked out our top 5. There are several other strategies, but we picked out our top 5. We're going to talk through them from the most basic to the most complicated in that order, welcoming live questions. I know people have sent us questions as well, through the teaching tax flow community. So I'm excited to jump into this. And most of these strategies are for any type of business owner. It doesn't matter if you're a multi-member LLC, single member LLC, S Corp, C Corp. We want you to be empowered with these ideas. But here's the thing. I always tell our people in our community that we work with, ideas are cheap. Implementation's valuable. So take these ideas, think about them, and find someone that you can implement these ideas with. If you need help finding that person, reach out to us right here at Teaching Tax Flow. We're going to guide you in the right direction.
Awesome. And Chris, you kind of opened up the door when you said, ask any live questions. So if anybody's curious, I can save you the trouble. Don't ask Chris for his barber's information, because he might not have that one in his proverbial Rolodex. But without further ado, let's jump into this. And we do tend to move through these at a pretty decent pace. So again, any questions, fire them off. If we do not get to them during this, we will either respond back to you privately or on a podcast coming up. I think, Chris, we talked about doing a podcast kind of in conjunction with this on the same topic, or we get to it on another session. So let's jump into some of these tax savings.
Right. And one more thing to add on, a lot of these we already have a full podcast episode on, or at a minimum, we have some more longer form, what we call a mini lesson, on our Teaching Tax Flow YouTube channel. So, this is supposed to be a quick hitter. If you're going for a 1-mile walk, a quick run, a commute to work, that's what I want this to fill your mind with, some ideas, and then we build on from that. So you're right, John. This is a flyover, and we're not landing any airplanes here, but we want you to feel empowered. So let's talk about the first one, the most basic one, home office deduction. So if you have an area of your home that is used exclusively and regularly for business, you should be deducting that against your income, depending on if you are self-employed versus a partner of or a member of a LLC, or a partner in a partnership, or an S Corp or C Corp. How you deduct the home office varies based on your type of entity, but definitely make sure you're taking advantage of the home office deduction if you're entitled to that. Don't leave that money on the table. It also plays a role in making sure that you're establishing that if your home office is your primary place of business, like mine, to be very transparent, I'm recording this from my home office, and now I don't have a commute, right? So there are times when I leave the hive here to conduct business, to do meetings or whatever, And every time I leave the house, if it's business related, guess what? Now I qualify for an automobile or truck deduction. So don't miss out on the home office deduction. Many of our people in the teaching tax flow community do use their home as their primary, place of business. Doesn't have to be your only place of business, but you do need regular and exclusive use. What that means is that the area can't be your kitchen counter where you serve meals to your family or cook meals. Now, it could be though, John. We have people that are podcasters that actually have a big closet that they built out in a podcast studio. That's a legit area. So yeah, home office deduction. Talk to your tax professional. You've got the simplified method and actual expense method. Pick out the one that benefits you the most and run with it.
Yeah. So Chris, we do have a question around this one, believe it or not. Somebody mentioned auto, but then talked about home. I don't see their name here on it specifically, so I apologize if we don't get to you or if there was multiple. But regarding this, I believe they're asking, like, what are the requirements to claim that home office deduction? Is it, you mentioned the closet, right? And I'm kind of adding to this question, can you have too small of a space? Doesn't sound like it. Could it be too large of a space? What does that look like? What's the minimum requirement?
Yep. The two requirements are your regular place of business, doesn't have to be your only one, your regular place of business, and exclusive use, meaning you're only using that space for the business purpose. It doesn't have to be an entire room. Hit pause. There are special rules, though, for daycare providers and special rules for people that store inventory in their house, and definitely talk to your tax professional about that.
Awesome.
So, yeah. So let's roll to number 2, though. No, yeah. Go ahead. I'm sorry.
No, say let's do it. Let's keep moving. Again, I'm kind of skipping over some questions here, so if we don't get to them, we apologize. Numero 2.
Retirement plan contributions. We know that, if you're an employee somewhere, typically that, let's say your employer has a 401k plan, you register for it under the Secure 2.0 Act. Actually, automatic registration is coming down the pipeline. And so when the money's coming out of your bank account or coming out of your paycheck as someone that gets paid on a W-2, you don't always think about retirement plan contributions. But as someone that is a business owner, you should be thinking about retirement plan contributions. Now, there's not a one size fits all. We've got things all the way from just a traditional or Roth IRA that span all the way up to super advanced defined benefit plans. And sometimes there's only almost too many options for someone. So here's what you want to do if you're a business owner. First thing you want to do is you want to figure out, okay, what's my marginal tax rate? Am I looking for an immediate tax deferral, aka a 401k or traditional IRA? Or is my marginal tax rate low and I might want a Roth option? Chances are, if you're listening to this webinar, you're that red diagnosis, you're looking for more tax deferral, right? Not the Roth option. The second thing you have to determine is, do I have people in my organization that I must contribute for them as well? Are you a Han Solo? You like Star Wars. You don't have any employees. Then you're not really worried about that. But what happens if you have 5, 6 employees or more, and some are full-time? Are you going to be required to contribute to them, which isn't necessarily a bad thing? The third thing you want to consider would be, okay, how much financially am I looking to commit towards retirement? I hear way too many times, I want to put the max in. The max depends on your plan. So I always push back on people. We talk to our clients all the time. We're gonna push back on our clients in a positive way, but make no mistake about it. We are on your team. But we've got to push harder and figure out the answer of, do you have an unlimited amount of assets that you're willing to put into retirement? If that's the case, great. You just made my life a lot easier. But if you're saying, hey, I'm looking to put $10,000 a year into retirement, I don't think a solo 401k plan that has more administrative expenses is better than a SEP-IRA. So figure out what your financial commitment is, and then talk to your tax professional, and that's where you bring in a financial advisor. We talk about you building out your personal board of directors. Bring those professionals in and design that plan that fits your needs. There are different due dates and different rules based on what type of plan you have, but there are several plans that you can actually make contributions. So let's say it's 2025 and you still have not had your 2024 return prepared yet. There are several that you can still make a contribution for 24, and some of them, if you extend your 2024 return, you can make contributions later into 2025. So I love retirement plan contributions. That's something, it's interesting on these these strategies. We use a lot of them in our own practice. So yeah, that's something that we use a simple IRA because we have a smaller team. We have about 11 people on our team, and we want to be able to contribute some money to our team members' retirement as well as an employer.
So what's your favorite retirement plan contribution? Would you say
My favorite is whatever
somebody that fit this mold?
Yeah, it's
Good answer.
situationally dependent. You know, we love that term. It's whatever fits your situation. If someone's self-employed with no employees, my favorite is a SEP-IRA, but for some people, a solo K plan might make more sense.
Excellent. I appreciate that.
Yeah. Right. So third one, income shifting. Oh, whoa, what's that? Number 3. Yep, 3 out of 5. Income shifting means, and I'm going to take a step back. It should go without saying, if you are a fan of teaching tax flow, our rule, or what we're trying to do, legally and ethically reduce the tax you pay in your lifetime. So when we talk about income shifting, that means that we are compensating either a person or an entity fairly for work that is being done. But why income shifting can work really well is that it allows you to potentially take income that is taxed at a higher rate and move it to somewhere or somebody that's taxed at a lower rate. One thing you have to remember, and of course, if you subscribe to the Teaching Tax Flow YouTube channel, you would know this, right? Not all income is taxed the same. Different types of income are taxed at different rates. So shifting income either to a spouse, to a child, or dependent, to maybe a parent that's helping with their business can significantly reduce the overall tax a household pays because those other people might be in a lower marginal tax bracket. So income shifting to a family member is one option, and then income shifting to a related entity is another. We're gonna our last one, our fifth and final one. We originally were only gonna do 4 of these, but we added a bonus one in. Is part of income shifting, but income shifting to a related entity. You might say, well, what does that mean? Well, what happens if let's say you were working out of your home and you grew and you need a little more privacy and you go and buy a small office condo. So let's say you own a little cleaning company, right? You go buy that office condo. You get to depreciate that office condo and you can pay rent from your operating company to the office condo operation at fair market value rent, and rental income is taxed differently than self-employment income. So again, there are a lot of different ways you can do income shifting between entities or income shifting between family members. So that's a little more advanced. Yep, definitely.
And I know we've seen and continue now even to see a handful of questions. It's almost like when we bring up income shifting and, hiring potentially family members, it's like everybody's lights go off and they wonder like, oh, I need to do this. I should do this. Obviously, it's not correct for every situation. But a question that we got here and also have seen many, many times over the years is, by doing so, say hiring a family member, does it increase the potential for an IRS audit? So does your audit risk go way up from this, or no?
I don't think it does. Yeah, I've never seen someone go through an audit and the auditor say, the reason we audited you is because you hired somebody. The bottom line is when you hire someone, if it could be a family member or not a family member, you're going to issue a W-2 to that person, and that person's going to report that income on their personal tax return. The only audit risk you have, there's always audit risk, but the only issue you'd run into is that if you're paying someone that's wages that are not fair for what they did. Okay, so that's we've used this, and I have my kids are 2 of them are in high school now, and I've got a 5th grader, and we do some special events, and my family pretty well. The kids have helped out with special events. My daughter has sometimes if we have a special event, my daughter will babysit because we have a lot of clients with younger kids, and let's say we're doing a special event or a marketing event. That's right. We have babysitting on site. I'm going to compensate her. Now, I'm not going to pay her $2,000 for the night of babysitting, but we're going to look at how many kids showed up, and we're going to look at how much the rates are for babysitting and compensate her fairly. So those are just examples of things. And then the other thing with income shifting is you want to look at there's income shifting, like I said, to dependents or to parents, but there's also income shifting to spouses. Typically, income shifting to a spouse isn't there, since there's a payroll tax involved. It doesn't always give us the big pop that other income shifting can, because you're doing a joint return. However, one thing we have to remember is tax strategies, they don't live on islands. They're blended, right? So John, let's pretend I had a tax practice and I had no employees and my wife helped me out seasonally. And now, mind you, if anyone that works with their spouse or even plays pickleball with their spouse, this could be challenging. But the spouse helps you out during that season, and that spouse gets paid fair wages. Well, here's what you could do. If I started a 401k plan, when I'm the only person, solo K plan, my spouse could be the other participant. Now I could double up my retirement plan contribution. So a lot of times, income shifting is also paired with retirement plan contributions when you're hiring family members. So that's just something to consider. These all don't live in a silo. They work together. They get blended. We say blended or stacked.
And you know what I just thought of too before we hit number 4 here? It's like every time, and I know we talk about blended strategies a lot, right? I almost think of, you get a smoothie, right? The whole point of a good smoothie is one that you don't go and order like, oh, I just want a banana smoothie, and they blend you up and give you like a banana puree. They're like, here you go. The best ones have another thing, ice, etc. in it, and then you're happy. So that's my corny analogy every day.
Yeah, it's a good example, John. Once in a while, I'm surprised I didn't come from one of the participants.
Hey,
proud of
I'll
you.
take a win when I get one, so I'm good. So that's where I peak at my knowledge there. So let's get into number 4. What do we got here?
So number 4, one of the most hot button topics in tax planning and strategy. It's funny, I had someone the other day tell me that they did this strategy and they were really, really proud of themselves. I don't know their whole situation, but based on one of the thoughts I had was, man, it doesn't seem likely that this is going to make much sense for that person, but it can make sense for a lot of people. Number 4 is to make an S Corp liberation election. So, and you don't form an S Corp, right? You form either a corporation or an LLC, typically an LLC, and then you elect to be taxed as an S Corporation. So S Corp election for someone that's self-employed can make a lot of sense. So now there are rules for making S Corp elections. You've got to pay yourself a reasonable compensation. But the advantages would be, quite frankly, there's one big advantage. The advantage is that you're reducing your overall payroll taxes or self-employment tax. That's the advantage of being taxed as an S corporation. So from a 30,000 foot view, let's say you own a cleaning business. Let's go back to our friend, the cleaning business, right? And let's say you're just a one woman or one man band and your net income is $200,000. First of all, dang, good job, right? And good job listening to this webinar. But you're over 150. You're in a very high marginal tax bracket. You have maxed out your Social Security wages at about 185. But you analyze this and you say, man, I made $200,000 because I'm really good. But fair compensation for what I'm doing, if I was to replace myself, is about $50,000. So maybe it might make sense to take my LLC, elect S Corp, pay myself $50,000 as a salary, and then under $150,000 is going to be taxed as a dividend or a distribution. And you just reduced your Social Security tax and Medicare tax, so your self-employment tax, let's say 15% for round numbers, by about $120,000. So in that case, you might mitigate about $20,000 worth of tax, but S Corp isn't for everyone. I would actually say many people jump in S corporations prematurely before they're even profitable, before they can even pay themselves the reasonable wage that they're supposed to. And the other risk of an S Corp is someone that's not paying themselves a reasonable wage. If you're going to be an S Corp, you have to figure out what your reasonable compensation is for the work that you do and pay yourself that. That's so when it comes down to, does electing S Corp, I see someone else say this person must be very interested in audit risk, which is fine. Does S Corp election increase my audit risk? Actually, I think it probably reduces it all in all. S Corps are audited less than self-employed taxpayers. However, S corps that don't pay themselves reasonable compensation or no compensation are audited at a much higher rate.
As we see, here's just a general question for myself and your, vast experience over 2 decades. You wise, champion. Yep. No. I said wise. Do you find that, I won't say people are misappropriating a S Corp election, but is there certain industries maybe, or certain situations where people are electing when they shouldn't more than others based off your experience?
Yeah. So the biggest couple of them off the top of my head. One is if you own rental property. You don't want to own rental property in S corp. Two, let's say that you already have a high paying job. Let's say you're a doctor and you make a salary of $300,000 working in a hospital, and then you do some side work, right? Many doctors do. They might be reading charts, doing things out of their home office, and they heard from their friend they should elect S corp. Well, they're already paying the maximum amount of Social Security anyway. Electing the S corp saves them no money. Actually, it just puts a few $1,000s extra into their accountant's pocket. Thank you very much for more tax returns to file and payroll to process. Or the third issue, and then we'll move on to number 5. The third one situation is going to be someone that we can't. Let's switch from a doctor to a dentist. Okay, let's say you have a dentist, you have a practice. Let's say, John, let's flip it. Let's say you're an anesthesiologist, right? You're freelance anesthesiologist. You're making $400,000 a year. You're self-employed. You decide you want to be an S corp. It's going to be hard for me to justify paying an anesthesiologist a reasonable compensation less than the Social Security wage max. It's going to be really hard. So the tax savings is diminished. So there are several reasons why you don't want to be an S corp. But again, for the right person, it could be really, really good. So it's kind of like mustard. I like mustard. I love putting mustard on a soft pretzel or on a salami sandwich. But you don't put mustard on your pizza. You don't put mustard on your eggs. You might. If you do, you're a wacko. Sorry to call the people out on that. So the point is yeah, it could be really good, but it's a lot of times overused.
Awesome. So definitely consult your tax professional before jumping for joy that you've elected to file as a.
Absolutely. And gosh, there are so many issues with S corp. So you'll have to look at some of our other content on that, on the S corp issues. So, but the last one, this is our bonus one, because we had a couple people reach out when we in our community and say, yeah, what happens if I'm making like $500,000 or more, $1 million or more? This session's over 150, but if you're really, really at that level where you're over $500,000, and you've got at least $100,000 a year, that let's say you're already maxing your retirement account and you just have excess cash, you want to shift income somewhere, but you don't have anywhere to shift it. You don't have a building, you don't have a separate entity. That's where considering using the 831B strategy might make sense. Now, we have an entire podcast episode on this. If this is of any interest to you, I'm not going to spend much time on this one because, again, we have an entire podcast, and this is really meant for over $500,000 of net income and over $100,000 or more of money or revenue that you're earning that you're not deploying either in the personal expenses or your business. But yeah, a captive reinsurance company strategy or 831B could make a lot of sense. And what happens from a 30,000-foot view is if you're a business owner, first of all, you have to go through the process of identifying if you're underinsured or have some uninsurable risks. And then you mitigate those risks by creating your own captive reinsurance company and paying that company premiums to get them off of your profit and loss statement. So again, not going to spend too much time on that one. That's just a bonus because we love everyone in the teaching tax flow community. But yeah, if your net income's over $100,000 in disposable or deployable capital is at least $100,000, this one really starts working great at $400,000 or more. So our clients that are $1 million more in net income, this is something we use quite often. Or take a look at it.
Absolutely. And Chris, looking at these two, even out of these 5, the 4+ bonus, We've done a podcast on every single one of these except for S Corp, which I think we're going to get to eventually on the radar. So if you're not following the Teaching Tax Flow podcast, first, shame on you. Your friends are. You should be too. But go check it out and subscribe to them, and you'll get those notifications when we release those new ones. Chris, I think we got to pretty much every question. We had a lot of them. I don't know if everyone here can see each other's questions or not, but some were redundant, or they asked them, and by the time I got around to asking you, you already answered them. So good job, sir. You've been doing this a little while.
What if someone has a question after listening to this? We might just have a resource for them. There might be a group they can jump into.
I think there is actually. And if, I believe the web address, right? It's defeatingtaxes.com. Yeah. Just kidding. No, it is literally defeatingtaxes.com. I almost forgot to mention that. So yeah, join in that group. It's a private Facebook group. You can post anonymously if you so choose. If you don't want your name on it, and ask any questions. A lot of tax pros in there, a lot of other individuals, business owners, employees, etc. So check it out. And as always here, I think in a week or so, we have another session coming up too. So we like to hit a lot of these topics in conjunction with a lot of the questions that we get, maybe even aligned with a podcast we have. It's kind of just a different way of having a little chat. So thank you everybody for joining us here. And again, subscribe to that podcast. We'll see you very soon.